Hello everyone, welcome to our channel Growth Investing, and I am your host and founder of Growth Investing, Narendra. I am a small case manager, and today we're gonna talk about one of our small case, which is GI Nifty Top 10 Blue Chip. Why we are talking about this small case? Because it comes under a part of core portfolio. So we have two portfolios which can be contributed or which can be considered as a part of core portfolio. One of them is GI Nifty Top 10 Blue Chip. GI means growth investing, and second is growth investing Nifty Next 50 large caps. So today's discussion is around Nifty Top 10. What is this small case made of? What are the constituents? What are its prospects? Why do we call it a core portfolio? What should be the future with this portfolio? Let's discuss it one by one. Nifty Next 50 is made of, the constituents are from Nifty 50 index. Nifty 50 is also globally known as our main index, just like Sensex. It consists of 50 companies by market cap. Market cap means current share price multiplied by number of shares the company has issued. So this is called as market cap. So we have picked 10 stocks out of 50 stocks and constructed a portfolio, and we call this portfolio as GI Nifty Top 10 Blue Chips. Blue chips because all of these companies are blue chips, right? Large, bigger companies or companies with a highest market cap in the Indian market. So who all invest in Nifty 50? So Nifty 50 as an index, so the global investors, which we call them FPIs, they invest in this. Domestic institutions, we call them DIIs, they also invest in this. HNI investors invest in this. And similarly, we had also created this portfolio based on the themes I discussed. Now, why next point of discussion is why this Nifty Top 10 has to be a part of your core portfolio. So let's talk about this. Why core portfolio? Because it has to be strong. It has to be an all-weather portfolio. It should stand all weather, whether market is in a downward spiral or in an upward spiral or in an upward trend, you can say. It should be reliable and dependable. You should have a peace of mind with a core portfolio, and it should have a consistency both in terms of the companies growth we have, the companies which we have selected, their growth, their earning growths, and their reliability in terms of projecting those numbers down the line for the year or next 2 years or next 3 years, say in a similar fashion. So core portfolio means you can rely on it whether you need that money in a short time period horizon or a longer time period horizon, right? With a peace of mind at your back, right? In mythological terms, you can treat core portfolio as Angad ka pair, foot of Angad. It means once he is putting on a foot, Angad has put on his foot on earth, it's stable, it's strong, and there is no one who can just pull him off, right? So Angad ka pair isko keh sakte hain hum log. Second point of discussion is what are the constituents and what are their weights in this portfolio. So what we have done is we have taken a concentrated approach in this portfolio. Out of 50 stocks we took 10, and then we took an approach of equal weight among all the 10 constituents or among all the 10 stocks. Equal weight means if we are investing 10 lakhs, then 1 lakh each is invested in each stock, and that's how it becomes an equal weight, right? Now the question is why equal weight? My reply to this is equal weight minimizes risk on the portfolio overall. If, for example, if some stock has got a bad news, example is January 2023, when Hindenburg published a report about Adani Group. So Adani Enterprises went down because of that news or Hindenburg research. By the way, Hindenburg is a global short seller. So the stock was, battered down heavily. So even if, assuming Adani was in your portfolio and from a 10% weightage, the stock went to 1/4 of its value from a high to a low, the bottom it picked, from 4,150 rupees to a level of low of 1000 rupees or 950 rupees. So even one stock is bettered, your portfolio as a overall doesn't got much of hit, because that one stock going by 50% or by 75%, it is spread equally. So ideally your portfolio would have been down by, keeping all the constituents same, your portfolio would have been down by, you can safely say 2% or 3%. That's all. That's overall impact on your portfolio. So that's why we call it equal weight. And why concentrated? Why concentrated means we as a retail investor have limited amount of money, right? So if we spread it across 50, 60 or 100 stocks, it means what will their contribution in our portfolio? Even if some stock goes double, that weightage, the weightage we have given to it, would not allow a substantial return on the overall portfolio, right? So the concentration approach makes you a good money. To give you well-quoted examples, even one of the biggest investors or one of the most famous investors, Warren Buffett, always had a concentrated portfolio, right? And now the current star of investing, Bill Ackman, you could see, I read it somewhere, that he is holding only, all his holdings are into 7 assets or 7 underlyings or 7 companies, you can say. So that's what the smart investors do, and that's what we should also do, the same approach of concentrated portfolios. Even though concentrated portfolios they have their own pros and cons. So in terms of pros, you get a better return as compared to the overall index or the market. Cons, sometimes it also goes down, higher, drawdown is higher than the index relatively. But again, then it recovers and move its on to the growth trajectory, you can say. So I have explained you both equal weight as well as concentrated. Now let's talk about the specific of this growth investing Nifty top 10 blue chip. What do you expect? What is your expectation out of this portfolio? Let me share that. What should be your... So the characteristics of this portfolio, it's a slow and steady wealth creator. Slow and steady means, doesn't mean very slow. No, don't take that. Slow means this portfolio is a mature portfolio. It will have something, a stable approach while consistently compounding your wealth for you, or the consistently increasing wealth for you or money for you in your investments. In this portfolio, I would say it can't be judged on a daily or weekly or monthly basis. You need a fair good amount of time to see a substantial output in terms of the invested money and the returns you get. I would fairly say 12 months is an ideal time to look at it. So lesser than this, it would be, you won't find that attractive. But yes, 12 months onwards, you would start loving it. And similarly, you can go and also check it out on our website, which is growthinvesting.smallcase.com, or you can also see it on a Smallcase app. Third important characteristic of this portfolio would be, this portfolio, yes, along with market, it will also go up, it will also go down, but it will do both sides respectively. It won't be volatile. So by volatility, I means a daily change in an equity, in an asset, or in an underlying. So volatility means daily change of percentage up or down, it's volatility. So it would be a lesser volatile as compared to small cap, micro cap, or the nano caps, you can say. And it will also be lesser volatile to mid cap, I would say. Yes. So I have also, in 3 pointers, I have try to give you a basic underlying or how this portfolio should behave or had been behaving, right? If the overall market is good, it will take calculated steps in the growth direction. If the market is not in a good mood, it should also go down with the market, but not aggressively. It will go in a respectable manner. So in short, and while summing up this portfolio or the core portfolio concept, I would say a core portfolio should be an all-weather product. All-weather product. Just like our home, we feel safe in our home. We know when it is summers what we need to do. So as a home provides us, it is cool while it's scorching heat outside. When it's a chilly winters, our home is warm. So take it your core portfolio as your home, and the way you respect your home, the way you take care of your home, similarly this core portfolio take care of for your money, right? For your hard-earned money which you have invested in this. Now, why you should be investing in this? This is a good question. Generally people ask it, why in large cap they don't move much? I won't buy that argument seriously. I would say, yeah, I have noted it down, because why you shouldn't be avoiding large cap or Nifty 50? Have a look and then you decide. What I mean is, a core portfolio or a reliable portfolio means what? All these companies have seen bare minimum 15 to 20 business cycle, right? Bare minimum. So what they have seen, they have hardened themselves while facing market. So they have seen all ups and downs in their business cycle. They have a well-established business model. They have established customer base. They have proven products. They have seen all ups and downs, whether it credit or government policies or economic uncertainties, right? So still, or what is important is, they are able to still generate consistent and steady return for your money. This is very, very important while you consider a core portfolio. So to sum it up, what they have is, they have a predictable and a consistent business model, revenue model, profits, earning per share. Ultimately, all of this predictability and consistency translates to what? It translates to your steady returns for your money invested in these stocks. This is important, right? And last point is, generally people ask me about this, how much should I put in a core portfolio? Again, I would say it's a beautiful question. People ask, yes, you should be curious about it. How much should I put? Frankly speaking, there is no such ratios defined statistically or theoretically into this. It is up to you how much risk you are able to take. If you are a very risk avert, you should deploy more into this. But in short, around 50 to 60% of your capital is the ideal way. And then you are smart enough, you can tweak it, you can go lesser to it, or you can go higher than this. But ideally 50-60% is what I feel should be in core portfolio, because that keeps your base strong, safe, steady, reliable, dependable. All right. So all these words which I quoted now are associated with core portfolios. So third is, what I generally say about this portfolio is, the main motive of this portfolio is your protection of capital with better returns than the benchmark, right? This is what I believe is the basic underlying core motto. But sure, you have to see this portfolio on our website or on Smallcase app to decide. And yes, equities market comes with risk, and being SEBI registered doesn't mean means that I can guarantee returns. No, I can't guarantee returns. That is up to the market. What I can do only is, I can select good stocks in this portfolio so that they give you better return as compared to the rest of the portfolios. And also all the links which I discussed are shared with you in the description box. If you like the video, this video, please do like it, share it, subscribe it. This also gives us feedback how many serious investors are watching our videos. Also, if you have any query on this, please do put in comment box, or you can WhatsApp us on our number, which is 98105 00199, or you can write us on our email, which is help@growthinvesting.in. That's all for the day. Thank you.